Welcome to the webinar. My name is Marty Schenkman. We have Jonathan Blottmacher, Sandy Glazer, and Joy Motak joining us for a presentation on planning for large estates. We're going to talk about a range of additional trust planning techniques, and the last segment will be on some practical tips on practicing safer, for which I hope Sandy Glazer will be very vocal and participative. Let's start with a quick word from our sponsors. Vanessa?
All right. Thank you, Marty. Hi, everyone. This is Vanessa Kanega. I'm the President and Director of Content Development with Interactive Legal. And I'd like to thank Marty and the panelists for presenting this webinar. Always good to get a head start on planning for end of year and the upcoming years. I'm looking forward to it. And thank you very much for giving us the opportunity to sponsor. If any of you would like more information on Interactive Legal, please visit our website, or you're welcome to email the sales@interactivelegal.com email address shown there on the screen. Thanks very much.
Thank you, Vanessa. And Peak Trust, Brandon's not with us, but we have another Peak representative.
Thank you, Marty. Yes, this is Deb Erdman stepping in for Brandon. So if you think Brandon's voice got higher, it did. Here at Peak Trust, thank you for the opportunity again to sponsor. Peak Trust is a professional trust administration firm. We were started well over 20 plus years ago as Alaska Trust Company. So we have an office in Anchorage. We opened an office in 2016, in Las Vegas, Nevada, and changed our name to Peak Trust Company. So we have two offices and two of the top trusters.
I think we may have lost Deb, so we're gonna go on. But Peak is a great administrative trust company and can assist in a lot of the planning that we're going to talk about. So let's jump into our topics and just start tackling them. We're trying to talk about what we as planners should be thinking about and talking about now. Because we're focused on large estates, GRATs will have a different answer perhaps than they may have in our prior discussion for more moderate estates. For moderate estates, I don't think GRATs make sense. They don't use exemption. And at this juncture in time, you know, estates 5 to 20 million, 5 to 30 million should be trying to use as much of the exemption as they can in advance of 2026, where the exemption is cut in half, or the 2020 election, or maybe 2024, we don't know, where if the Democrats take over, we're going to see significant changes. For much wealthier clients, presumably they've used much or all of their exemption or will use it in much more robust transactions. So GRATs may make sense because they may not have exemption left and still may want to freeze values in advance of the 2020 election. Certainly seems sensible to do. But GRATs may have to be different in light of a number of the changes. Some of the differences are that if the Democrats do take over in 2020, the restrictions that have been talked about, say, in the Sanders tax proposal, and I'm not suggesting that Bernie's necessarily going to get elected, but in the Sanders tax proposal, which were discussed in pretty much every proposal Green Book by President Obama, talked about greatly restricting GATS, 10-year minimum term, 25% gift on formation, and with a 10-year term, it's just not going to happen. With a 25% gift, it's just not going to happen because the whole point of most GRAT planning was to use 2-year rolling GRATs or cascading GRATs and try to outperform, say, the 75-20 rate with the upside volatility, slice it off, and get that appreciation out of the estate. What might make sense now? Well, one of the things that may make sense in anticipation of the 2020 election is perhaps for one of the first times looking at more moderate term GRATs. In other words, if a client's looking to shift business interests out of their estate, if you can't count on rolling or cascading, repeating the GRATs after the election, a 2-year GRAT may not be the optimal approach. It might make sense to use a 5, 6, 8, 10-year GRAT so that you can plan differently to shift assets out of the estate. For example, you may structure a longer, more medium-term GRAT where the distributions out of the business interest, the discounted business interest in the GRAT may be sufficient to pay the annuity payment. Does anyone want to comment before we talk about 99-year GRATs?
Yeah,
Go ahead, Jonathan.
Well, let me make a couple of things. Number one, Marty is right that we should be encouraging our clients to use their exemptions, but you really want to use it, you got to do it all. In other words, you say, well, I've got an $11 million exemption. They're going to cut it in half. so I'll use 5.5 million now and preserve the balance for when I die or later in my life. You can't do that. The good news is that they won't claw it back to the extent you've used it when you die. But what they do is, the way the computation works is, if you give away 5.5 million and you die or make a further gift when the exemption has been reduced to 5.5 million, you get zero. It's just the way the computation works. So that's something that you really need to keep in mind on this. The other thing with GRATs is, I wrote, I think, one of the first articles, and I suggested that maybe you wanted to have a very increasing annuity coming out of a GRAT. And unfortunately, which happened to Marty and me about a year ago, we talked about using non-grantor trust to save income taxes. The service found out about it, so when they came out with their regs, they said you won't get any credit for an annuity from a GRAT to the extent it increases at a rate of more than 20% a year. Well, and that's what the regs say. But actually, if you run the numbers, you want a vastly decreasing annuity. If you're going to do an annuity, because you can do another GRAT with it, at least under current law, you want a annuity that decreases. So you have the ability, in effect, to do a 1-year GRAT. You do a 2-year GRAT where you say, first year, pay me 99% of the value, and then the second year, pay me 1%. Why do you do that? Well, if you've had great increased value in the first year, and you take back 99%, you're going to leave money in there. You don't have to worry about bad performance in year 2, taking away that good performance you had in year 1. On the other hand, if you have poor performance in year 1, you're going to get it all back, and you could re-GRAT it. So that's a kind of counterintuitive to, I think, what most people believe. But if you run the numbers, you're going to find out that maybe using short-term GRATs with, and it's clear in the regs, you can have a decreasing annuity to the extent you want. So that's something that I think people should think about.
Joy, you were going to comment?
I just wanted to point out that what you had said in the beginning about how the Sanders plan and the Obama Green Book is sort of coming back during this election season harkens back to what we had talked about in our earlier webinar, which is that it's not just about the exemptions being reduced from $11.4 million to something much lower. It's about the actual techniques being changed. So if you love these techniques now, you probably should be investing in adding them to your plans at this point.
One last point on GRATs in this environment. If you're going to do a 6, 8, 10-year GRAT because you may not be able to roll or cascade it after the 2020 election, the immunization of that GRAT is going to have to be handled differently. GRAT immunization is the concept of, if you get a real bump in value on the asset in the GRAT, you swap it out to freeze that gain inside the GRAT. So as Jonathan said, if there's a drop in value the next year, you're still good. GRAT immunization has typically traditionally been done with just treasuries, CDs, or cash. You're not going to hold cash for 6 or 8 years if that's the term of the GRAT. So it's going to require some more input by the financial advisor, investment advisor to make that work. Let's go on and talk about 99-year GRATs, because that could be an interesting play as we get close to the election. And while I think in general, and one of the themes of all we're talking about, get clients to plan now because there's a lot more that could be done with perhaps more certainty, here's one that you may be able to do closer to the finish line when you see how the election looks like it's going, perhaps later in 2020. A 99-year GRAT is really an interest play, because what happens if you don't survive the term of the GRAT, it's not the corpus of the GRAT that's included in the estate, but rather the amount of corpus that's necessary at the then current 75/20 rate to provide the annuity payment that is required by the GRAT. So if interest rates are, say, for 2% now, and when the client dies 20 years from now, they're at 10%, you're going to have a significant amount of the GRAT asset corpus not included in the estate, because a much lower corpus at the higher interest rate will generate the necessary annuity payment. So for very wealthy clients, as we get close to the election and they still have assets that are exposed and it may look like the Democrats are going to win, a 99-year long-term GRAT could be an interesting play. Jonathan, I think you were going to comment?
Yeah, the guy who developed that is a very bright Kentucky lawyer named Turney Berry. And he told me about this 5 years ago or so at a bar meeting we attended. I had never thought about it. I think it's a great idea. And the reason that you save money if the interest rate rises by the time you die is because since the trust is now going to be deemed to earn more each year, you thought you were only going to make 2% a year. You die, it's assumed that the trust is going to make 10% a year. Obviously, you need a much smaller base of wealth to produce the annuity. If you're earning 10%, then you're earning 2%. The numbers are quite compelling, and you can even get out of this during your lifetime. This GRAT is obviously going to be a grantor trust, and what you can do is basically buy it back from the trust. So interest rates, you're like Marty, you're going to live to your 973, which I think is Methuselah's age. But, you say, well, look, I'm going to live a long time. And then 5 years later, the interest rates go up from, say, 2% where you started to 6%. And you say, gee, this would be a good time to die because I'd get so much out of my estate because so little of that GRAT is going to be includable under the regs under Section 2036. Well, just buy it back. That's going to be an income tax-free transaction. You buy it back. You put in $10 million, and now you buy the thing back now for much, much more. You're going to buy it much, much more. So as long as interest rates rise, or as long as the value of the trust goes up substantially, you can buy it back and you'll leave money completely gift tax-free in the trust. A great idea. Now, I also want to mention one other thing, and that's a concept I developed called the SPLAT, which is a split purchase annuity trust. What you do is you have a trust and you have the client buy an annuity, say for her life, and a generation skipping exempt grantor trust buys the remainder in that. And as a consequence, there's been no transfer. You need an old and cold GST exempt trust, but if they're both grantor trusts with respect to the client, you can do that. And that means that when the client dies, nothing is going to be includable in her estate because she purchased something like a regular annuity, which disappears when you die. And in fact, it's even possible to use this with a client with an exceptionally short life expectancy as long as their death is not imminent, which means they have more than a 50% chance of survival for at least 1 year. And if you've got a client who says, I want these payments to continue for my life, you can do it by this SPLAT where the client purchases from the trust the right to the annuity for the rest of her life, and the GST exempt trust buys the remainder. Normally, we believe that you cannot get property that runs through a GRAT GST exempt. There are some talk about, well, maybe you sell the remainder and stuff. The IRS says that doesn't work, but this you can do it. In fact, if you get the BNA Tax Management Portfolio, it's number 836 by Georgiana Slade, Diana Zedel, and me, we talk extensively about SPLATs. So that's something that I think you might want to consider.
Thank you, Jonathan. Let's go on. Jonathan, since this was something you've done a lot with, you want to briefly comment on community property trusts for large estates and why it may be an interesting play?
Well, I've always been jealous of the benefit which married couples who live in community property estates get. In fact, I've gone up to Albany 6 times asking that the New York legislature allow New Yorkers to have a community property regime by an elect-in system. And of course, when you have community property, it's owned half by the husband, half by the wife, or whatever, even in a same-sex marriage, half by each. The benefit comes up under Section 1014B6. 1014B6 says when the first spouse dies, something that's community property under the law of any state gets not just a step up for the half owned by the spouse who's just died, but also the half owned by the survivor. So if my wife and I own community property and I die, not just my half gets stepped up, but my wife's half gets stepped up as well. New York has always turned me down on it. What really made it happen for me is that Wisconsin adopted the Uniform Marital Property Act about 25 years ago. And the IRS ruled that property in Wisconsin was basically community property. And the Wisconsin lawyers love it because their married clients enjoy that double step up in basis when they die. In 1998, I asked Alaska if it would adopt an elect-in community property system. Now, in all the other states like Texas, you have to elect out of community property. You can have a pre-marital agreement or post-marital where you elect out. And in fact, it's interesting that in all those states, you can elect in with respect to your separate property. So Marty moves to California, and he and his wife can then elect to have their separate property made community property. To that extent, it's an elected system. But the basic fundamental is anything that you acquire while you live in a community property state is community property. Germany, in this case called Angerhofer, tells us that for federal tax purposes, you have to have certain elements for it to be treated as full community property. And Mr. and Mrs. Angerhofer didn't go all the way. So, but the court said, gee, if they'd gone all the way, even though it's an elected system, you can go ahead and have it be community property. So I went up to Alaska in 1998 and I said, hey, how about letting your residents elect into community property to the extent they want? And also, why don't you allow people from outside of Alaska be able to elect into Alaska's community property system by creating an Alaska Community Property Trust? And to the extent that a couple in New Jersey, New York, Florida, Oklahoma, any non-community property states creates an Alaska Community Property Trust, which will contain a recital as to what is community property under that trust under Alaska law, they will now have community property under the laws of the state of Alaska. And some people say, well, that won't really work. Well, why won't it work? It's community property under the law of a state, the state of Alaska. And that's what 1014b6 says. Now, Tennessee adopted a similar act. South Dakota adopted kind of a system, but I don't think it qualifies because it doesn't really have a community property system. Alaska has a full community property regime. It's got everything that California or Texas or Wisconsin has. In fact, I basically copied it from the Wisconsin statute, which was based upon the Uniform Marital Property Act. So I think it does, but South Dakota really doesn't have any community property. So how can you say it's community property under the laws of the state of South Dakota when South Dakota really doesn't have any? But maybe that's just my opinion. But I'm pretty sure that's the case based on the Angerhofer case. But Alaska, Tennessee, I think you can do it. And my question is, why wouldn't you do it? Why wouldn't you say to your clients who are married couples, hey, let's create community property? It's basically a joint revocable trust, which is used as a will substitute. And joint trusts are used in many jurisdictions. I've done it for couples in New York, even who weren't creating Alaska community property because they wanted to own things together. And that, just like a revocable trust, basically makes the primary dispositions of the couple's property as they die.
Let's go on. Let's talk about another topic that could be of interest for large estates. So 2519 is sort of a nuclear option for the IRS. If a surviving spouse gives up any portion of his or her income interest in a QTIP, it's as if the entirety of the QTIP were transferred, triggering potential gift tax. Now, that can be used as an affirmative planning tool and represents a very interesting planning idea to take a look at today for those looking to use their exemption. But focusing on bigger estates, it presents a potentially significant issue or risk that needs to be addressed in planning. And why is this planning so important? If we look at the potential changes, and as Joy pointed out, not just in the exemption, but in planning techniques, that are being proposed by the Democrat presidential hopefuls that were in the Bernie Sanders proposal that was submitted to the Senate, I think, April this year, the Obama Green Book, which seems to be the foundation for all this. It's going to be very difficult to plan if the Democrats sweep in 2020. So if you have a client that's got a large Q-tip, that's going to be taxed in the surviving spouse's estate. On a lot of large estates, the Q-tips may not even be GST exempt. So it would be a great thing to get assets out of the Q-tip and engage in a transaction today before these potential changes. So for example, if you can have interest in the family business held by a Q-tip distributed to the surviving spouse, and then the surviving spouse engages in a note sale to a grantor dynasty trust, maybe all that will be grandfathered despite what gets changed after a 2020 election. We don't know for sure, but it certainly seems like it may be well worthwhile to take the shot at that rather than wait and see, because then it may be too late to plan. So here's one of the issues. If you have assets in a Q-tip and you distribute them out, is that the same as the surviving spouse giving up an income interest in the trust? Joy, do you want to chat about the Kite case, or do you prefer I blather on?
I think you should blather on a little bit about that one, because I have some thoughts, but I'd like to just have you go through.
So I don't want to spend too much time belaboring the Kite case, but the Kite case is one of those horror cases that brings up the specter of 2519, and I guess this is perfect timing just before Halloween, because that's kind of what Kite was like. But the facts in Kite were terrible. There was a distribution from a Q-tip followed by a contribution or transfer by the surviving spouse to a charitable lead annuity trust, a CLAT, that was structured as a deferred CLAT, so that the surviving spouse wouldn't get any distributions, any annuity payments out of the CLAT for, say, 7 years. I don't remember the exact number of years, but it's inconsequential. They did all the calculations correctly, but the surviving spouse died before getting a single annuity payment. So those facts kind of invited a 2519 challenge, because you had assets in a Q-tip that were in effect distributed to the spouse, and very quickly, shortly thereafter, contributed to a CLAT that never ended up paying anything. So, you know, the difficulty, and this is the same challenge we have with facts like the Cahill case on split dollar, the Powell case with FLPs, is when you get really horrific fact cases, how do you apply those to, you know, more reasonably planned transactions? But the 2519 risk remains pretty significant. What do we do about it? By the way, one of the first things you want to make sure, if you're trying to get assets out of a Q-tip so you can structure them to be out of the spouse's estate, perhaps into a GST envelope as well, is there provision within the Q-tip to be able to even make this distribution? If the Q-tip has a HEMS limitation, you may have a real problem. If the Q-tip is unclear, you may want to think about what you might need to do to secure or corroborate that you can distribute. If you have an unlimited principal invasion, then it certainly seems plausible. So let's say the surviving spouse can get assets out of a Q-tip and engage in a transaction. One of the issues that arises is, if there's a 2519 challenge, what do we do to try to mitigate or deflect the challenge? Well, first, one of the things you can do is try to take steps to prevent the IRS from aggregating the distribution from the Q-tip and the subsequent transaction by the surviving spouse. So, for example, if S-Corp stock is distributed from a Q-tip to the surviving spouse, have a new shareholders agreement drafted and signed. Perhaps have a distribution made out of the S-Corp so that the surviving spouse gets a distribution while she's holding it. Perhaps there could be significant business events that occur in that interim period. And certainly you don't want any documentation that it's being pulled out specifically to transfer to a new trust. So, and the more time that passes from the distribution from the Q-tip to the surviving spouse's transfer, perhaps that also will help mitigate a 2519 attack. So you can certainly take steps to try to negate the aggregation of the steps, which was necessary as I read the Kite case. But there may be something else you can do, and that's sort of the gist of this little planning tip for large estates. What if you divide the Q-tip trust before the transaction? There was a 2014, I don't have it here, I'm sorry, but there was a 2014 PLR, and I think there was a subsequent one that talked about the following. The 2014 PLR suggested that you could take a Q-tip trust and divide it into three. One of the parts of the Q-tip was left intact, no change. Surviving spouse got her income interest. Another part of the Q-tip did exactly something Jonathan mentioned earlier. It made a unitrust election, and I guess that the unitrust election, if it was, let's say in Delaware, 3 to 5%, if it was a 5% unitrust election with current low interest rates, that may have given the surviving spouse more cash flow in a year than the entirety of the Q-tip did before. The third part of the Q-tip goes back to one of the first points I made on this topic, which is that they intentionally had the surviving spouse disclaim her income interest, or part of it, so that it would trigger a gain, use up her exemption. That's a great planning idea for more moderate wealth clients that are uncomfortable giving up assets they have, because the assets in the Q-tip may not psychologically be viewed by the surviving spouse as in his or her control. So making a 2519 disclaimer to intentionally use up exemption may be a great planning tool. But let's apply that PLR in a different context. What if you divide a PLR before the distribution of, let's say, the same example, S-Corp stock to the surviving spouse, so that you have one part of the Q-tip that has the S-Corp stock that's going to be distributed, and everything else is in a separate Q-tip? By dividing the Q-tip, might that serve as a wall to divide the portion of the Q-tip trust over which the IRS could make a 2519 argument? By dividing the Q-tip before you make the distribution, you arguably now have two separate Q-tip trusts, so that if there is a 2519 attack, you obviously want to mitigate that in some of the ways that I've suggested a few minutes ago, but you argue that the rest of the Q-tip should not be subject to that challenge because the Q-tip was divided. Anyone want to comment before we go on to another topic?
Yeah, Marty, on the issue where you have a HEM standard for invading principal, I had that one time, and this was out in the state of Utah, but we got a ruling from the local judge that in order to assist the widow with her estate planning, that was covered by the HEM standard, and we had an order, and the court said, you know, we could do it, and we did do it. We invaded it and then did a transaction with the assets that had previously been in the trust. Keep in mind, and this is one of my favorite rulings, Revenue Ruling 73-142 says, if you have an order from a local judge, once the appeal period has expired, everybody in the world, including the IRS, is bound, even if the decision by the court is wrong. So even though they had hired another lawyer who said, oh, you're going to lose, the IRS will never accept that. Well, they have to under their own revenue ruling, 73-142. So you could go to court, go to your local court, make your argument. In fact, if you want to do it, I could even send you the papers that we put in. And the court was convinced that allowing this woman to do her good estate planning, it worked. But Marty is right. 2519 is a nuclear bomb that the IRS can try to set off. And the most important thing you can do is to have sufficient space and time and events, like Marty said, get a dividend out of the corporation. Have the surviving spouse use it for a personal reason. He buys a yacht or whatever it might be, to show that it really is the surviving spouse's property. It just didn't go in there for 24 hours and then go into the further event. I don't think the Kite decision is right, as much as I respect Judge Elizabeth Parris, who's a very bright lawyer. But I just think it's a bad one, but it's there. And unfortunately, the Congress hasn't given me a vote. So, you know, take your time, have space, have a lot of things happen, and I don't think you're going to have a 2519 problem.
I want to jump
and buy
in
extra
here, John,
insurance of dividing the trust. Go on.
I wanted to just indicate that while you may have been able to get a favorable ruling, did you say it was in Utah? I think it's very state specific, because I can tell you here in Michigan that a fiduciary was found liable when they made a distribution so that a surviving spouse could make a charitable gift out of a Q-tip trust. They said that it violated the HEM standard, and that was not permitted under the HEM standard, and therefore liability was found. So I think it's very state specific as to what some state courts will say is or is not within the confines of the HEM standard.
and you need to know that when you're doing this kind of planning.
Right. Well,
Thank
again,
you.
Sandy, what you want to do, obviously, before you do a questionable invasion, is go to the court and ask. And if the court says, the trustee can do it, then you can do it. And that way you protect everybody, I think.
Agreed. Let's go on to the next topic. I'm going to do this one very quickly, just to make sure folks are aware of it. The Hart-Scott-Rodino Antitrust Improvements Act has provisions that in certain cases you have to give a pre-merger notification to the FTC. And what does this have to do with estate planning? It sounds like it has nothing to do with it, but it very well may. If you meet the size and other criteria for transaction, and again, our topic is talking about large transactions, you may have a requirement to report to the FTC. And we've never had an issue. We've had Securities Counsel deal with this when it's come up, or had Securities Counsel confirm, because it's not something that I have the expertise in, that it did not apply. Where we've had to get FTC approval, we've not had a problem, but you don't want to risk not doing it, because the penalties for not filing are horrific. Now, it almost seems sort of counterintuitive or illogical, because how is this affecting antitrust matters if a family is transferring entity interests in a family business to a family-controlled trust or a family-created trust? It doesn't seem like it has any relevance, but it really can apply. And one of the issues, without getting into too much detail, is the exclusions from this applying are very narrowly crafted so that common note sale transactions may in fact trigger this. If the trust protector has the authority to change the trustee, they may have requirements that could trigger this. So some of that's explained here, but again, the key is if you're about to undertake a large enough transaction, get Securities Counsel involved. Better to be safe than sorry. Let's go on to another topic on slide 18. The idea here is to differentiate collateral. What do I mean? The classic example of a note sale transaction is client sells stock, LLC interest in a closely held firm to a trust. And that equity, let's say the LLC interest, is used as the collateral to secure the note the trust gives to the seller, the client. Leaving aside the issues of guarantees and seed gifts and whatnot, the way the classic transaction is discussed is not necessarily the only way to structure a transaction. So here's a thought. We all know that if somebody dies and there's a note outstanding, the IRS will argue almost assuredly that the decedent had a 2036 retained string in the asset by virtue of the note payments they were giving from the asset. Question, what if you mix it up a little? What if you have an old existing dynasty trust, because many of our clients have existing grantor trusts, many of our clients have been doing planning since 2012 and before, and instead of using the ABC interests that were sold to the trust today, before the 2020 election, as collateral, you take that old and cold trust and use a different asset that's already held in the trust, XYZ stock or XYZ LLC, and make that the collateral for the note. There's no reason you have to specifically use the asset being sold, the private equity interest being sold as collateral. What if a different asset is collateral? Might that be used to deflect that almost assured knee-jerk 2036 string argument that the IRS might challenge it with? Anybody want to comment?
Well, it definitely seems like that would be a good strategy in order to avoid the pullback. Now, but what if somebody doesn't have a trust that has an asset in it that it would be able to use as collateral for the loan? Then I think you have to start looking at other alternatives to secure the note. And I agree that it would have to be done without using ABC LLC interests in your example as the collateral, because you risk you risk two things. One, you don't want to actually have to pull the ABC LLC interest back into the transferor's estate, even if you're not talking about the IRS forcing that to happen, but even if the note can't be paid, you would want other assets to be used so that you can keep the asset that we expect to grow and appreciate in value. Otherwise, you lose the value of the estate plan to begin with. So I think you want to be looking at other assets in there to collateralize the loan, or potentially other ways to secure it.
I don't think you have a problem using the asset you're selling, because that's traditionally how most of these transactions are done. But I do think you mix it up a little and make it a little harder to perhaps argue that string when it's not that stock or that asset that's securing it. Let me give you a different spin on the same kind of thing. Again, trying to mix it up, because we don't have to use the standard templates that are typically used for planning when you got an old and cold trust that has other assets. So the typical way that you do a transaction now, let's say it's a new trust, and you don't have enough seed assets according to the mythical 10% seed gift. I hate to even call it requirement, put the word requirement in quotes, that many people talk about. But what if instead of if you don't have sufficient seed gifts, so many commentators suggest use a guarantee. You have another trust, family entity, beneficiary, et cetera, give a guarantee. Now, the typical way a guarantee is structured is that what you do is, if the buying trust defaults and the seller, the client, the settlor, proceeds against the buying trust and can't get satisfaction, then they go against the guarantor. What if you flipped it and had the guarantee first in line? Does that change anything? Does that mix up how the IRS would argue that the equity that was sold was the collateral? That may be just another way to mix it up and try to cut those arguments that the service often uses. Now, if you use the approach that I just suggested, you need to get an appraiser that can understand the different risk that this type of guarantor is facing, because it's substantially different than the traditional risk, and the fee for that guarantee may have to be significantly higher. So just a thought. I don't think we want to belabor it. Let's go on to another topic. And again, our goal is to try to cover a lot of different topics that may be useful in planning for large estates before the 2020 election. Wandry clauses post-Powell. How is Wandry and Powell, how do they interact, and how might that affect what we do with the defined value mechanism? Joy or Sandy, do you want to set the stage with a brief, quick description of Wandry or Powell?
Yeah, sure. So in the wake of the decision, the tax court decision in Wandry, practitioners have been putting in defined value clause in their transfer documents. So the way that works is that I am transferring assets with a value worth X. I know what my limit, what my exemption is remaining, and I want to transfer that value into this trust. And I'm not transferring 20 shares. I'm transferring shares with a value worth $2 million, for example. And by doing that, we can say that we believe the value of 20 shares is $2 million, but to the extent that those values are, the value of those shares are changed on audit, then X, Y, and Z is going to happen. And that's really where the creativity comes in, because what we don't want to do is make a gift in excess of that $2 million. So by way of example, we may want to structure it so that to the extent that the value of the shares that were deemed to have transferred into this trust are concluded to be higher than the $2 million that I want to transfer, then I didn't transfer those shares. So I only transferred shares with a value of up to $2 million. The balance would be back in my hands. And that to the extent of that change, then I will not have been deemed to make that transfer. That's one alternative. Another option would be to have something else happen with those excess shares. So in this example, let's say that 20 shares I thought it was worth $2 million, and I want to make a gift of $2 million. As it turns out, 15 shares are $2 million, and 5 shares are worth some excess of that, in excess of that. Well, I can say that in my Wandry clause that I want to treat any excess over the value that I choose to transfer, that $2 million, as a purchase. Because I'm using a grantor trust, that purchase agreement would not create any income tax consequences. And the suggestion, the recommendations that we would make is to actually enter into a purchase agreement with a promissory note that says value of the sale to be determined as part of any revaluation by the IRS. So that way you would be able to still get the assets out of the person's estate, out of their taxable estate, but you would not be using any additional gift exemption.
Let me just sort of clarify and highlight that a little, and I'm on slide 24. The issue in the Powell case was a 2017 partnership case, another horrible fact, not bad, but horrible fact case. And in Powell, the bottom line was under 2036A2. It was argued that there was the decedent in conjunction with others controlled the entity interest transferred, and that was re-echoed in the Cahill case, was a split dollar case. So it seems that in conjunction with 2036A2 argument has some strength and legs. So in your traditional Wandry clause, as was explained, if you sell $2 million worth of stock and it turns out that the value is half of what the IRS wins it being, you've only transferred half the equity out of the client's estate, half remains in the estate. My worry is that in a traditional application of Wandry where the decedent never transferred or parted with some of the equity, private equity, that now the IRS is going to come and say, all right, you know what, great, we respect your Wandry clause, and half those shares are not going to trigger gift tax because of your successful Wandry clause. But oh, by the way, under Powell, the decedent in conjunction with the trustee of the trust control the whole thing, everything's back in the estate. So they could almost agree with your Wandry clause and then nail you on Powell. So one of the things that I've tried to do in some of these Wandry cases where I really don't want to have stock or equity left in the estate of the decedent to transfer while they're alive is do what I call a two-tier Wandry clause where, as was just explained, there'll be a secondary purchase agreement signed at the closing agreeing to sell any of the equity that remains under the Wandry clause in the estate to a trust, or maybe even a different trust, for the gift tax value finally determined. No gift tax implications, but now we've transferred everything to cut off the Powell case in case the decedent dies, and now we have an in conjunction with argument. So just trying to give you some different ideas in order to mix it up and see if you can get a little more security in it. Now, another defined value mechanism, which some people don't love, is a king price adjustment. There, you're selling $100, $100 million, whatever it is, of stock to a trust for a note, and instead of adjusting the amount of stock that's transferred, it says that the face value of the note will be adjusted upward if there's a gift tax value is finally determined. Steve Gorn, who's a very clever practitioner, suggests possibly having the face of the note based on gift tax value is finally determined. I'll leave it to you to ponder that. It's certainly an interesting concept. Some practitioners are less comfortable with the King approach because it's only a 10th Circuit case. It wasn't like Wandry and so on. If you read King, it seems that it may be viable, but it seems to have a business purpose or motive in addition to estate planning. So just be cautious when you apply it. You may want something that in terms of a transaction or a fact pattern that is not your typical estate planning. But keep it in your quiver because it could be interesting. By the way, you got to be careful doing any of these things. If you have S Corp stock, you don't want to risk undermining the S Corp status by virtue of a trust that is owning S Corp stock, losing the ability to hold S Corp stock. We all know a grantor trust can hold S Corp stock, but when you have transactions with non-grantor trusts, and as we try to get things shifted out of less efficient to more tax efficient structures in advance of the 2020 election, we all may find lots of clients have assets held, S Corp stock held in older trusts that are no longer grantor because the grantor may have passed away and so on. What do we do? So if you have an SBIT that's selling stock, S Corp stock, to a trust, does the SBIT, if it sells all of its stock, lose its S Corp status, its SBIT status to hold S Corp stock? And I think it does. If an SBIT, electing small business trust, sells all of the stock that it owns in the S Corp, it's no longer going to have a valid SBIT election because it no longer has any S Corp stock. One of the possibilities is having that trust, if you're doing a Wandry type clause, retain one share of stock in all events or some fractional share of stock in all events so that it retains its S Corp status. You don't want to find that you've sold stock from a non-grantor trust, and then when the IRS challenges the sale and has an argument that some of the stock didn't transfer because you used a Wandry clause, that now the S Corp stock is no longer held by an SBIT. What is the interim period? If it took 5 years for the audit to resolve and then you find 5 years later that you had S Corp stock held still in this formerly SBIT, is it still an SBIT? That's a risk you probably don't want to take. Now, why would you have a Wandry clause if a non-grantor trust is making a sale? It's not like the client taxpayer individual is doing it. How can a trust make a gift? The IRS can impute a gift to a trust and argue that the gift is deemed made by the beneficiaries. So if you're using a price adjustment clause, who even files a gift tax return? The beneficiaries, presumably. Will that toll the statute of limitations? Don't know. But what else can you do? Anybody want to comment before we go on? I'll take that as a no. So here's another interesting question that can come up on some large transactions. What if you have a non-grantor trust engaging in a sale? Now, why might you even think of doing that? We always assume it's a sale to a grantor trust. Well, what if you have a non-grantor trust, husband made a note sale transaction, made gifts, did grats, whatever, and passed away, and now you have stock held in a non-grantor trust. It's no longer grantor because the grantor has passed away. Those shares may have had a step up in basis on death. The stock may have declined in value. May be unusual, but it does come up. And so now you may have this non-grantor trust engaging in a transaction. Or alternatively, you may have had stock that, let's say, husband owned and transferred outright to wife on his death. The stock got a step up in basis. So there's no longer any gain today. And what might happen is the wife is now selling to a non-grantor trust. Why might you do it? Because the non-grantor trust may have significant assets, so you don't have to worry about these seed gift issues because there's significant assets in that trust to make a purchase. Whereas if the surviving spouse sets up a grantor trust, which is the typical way you would do it, you may have issues getting enough assets in the trust to make it look viable, or then you have to use guarantees, which raises more complications and issues. But if you're selling assets to a non-grantor trust, what do you do? Thought on the bottom of slide 29, maybe you want a two-tier defined value mechanism, because there could be both income as well as gift tax audits of that sale. Surviving spouse, for example, sells stock, no gain because of the basis step up on husband's death, to a non-grantor trust. If there's an income tax audit, it could be argued on the income tax side that the transaction was part gift, part sale, which reallocates the basis of the stock and could end up with an income tax gain. So you need a defined value mechanism to address that. If there's an argument that the surviving spouse made a gift, and that's traditional in a note sale, that you report it as a non-gift taxable transaction on Part 3 of the gift tax return, Schedule A, so that it's a non-gift transaction and you want to toll the statute of limitations. That's how we normally approach and think about gift tax audits. But again, it could be both. So you may need to integrate both an income tax and gift tax defined value mechanism, because you could have one or both adjustments on an audit. Anybody want to comment?
Well, I don't see any way that you would be able to avoid reporting it on an income tax return, because the non-grantor trust in the situation that you had laid out is a separate taxpayer from the surviving spouse. So I think that the most prudent course would be to report it in both bases. and make sure that you are meeting adequate disclosure on the gift tax return. Perhaps the surviving spouse in that situation should be making other gifts so that the only thing that's being reported is not, so that it's not just the sale that's being reported on the gift tax return, but there's some other substance, some other transactions that are also being reported. But I would also want to see it on the income tax return of the surviving spouse, showing the sale to the non-grantor trust.
Absolutely, on all points. And you would peg your income tax audit adjustment in your income tax defined value mechanism to the income tax reporting, and the gift tax to the gift tax reporting. Any other comments before we?
Well, I think you would put a footnote on it as well to make sure that you're specifically telling the IRS that the purchase price is X, but in the event that something is, revalued for estate tax purposes, that the purchase price will be, or gift tax purposes, the purchase price will be changed.
Yeah. Let's go on to slide 31. Let's change gears and talk about another topic that could be important to a large note sale transaction. If we do any of these defined value mechanisms, a Wandry clause, a Christensen type clause, etc., we may not know for many years which of the various trusts or entities or people own what exact percentage of stock. We do know that we believe, perhaps for administrative convenience, we're going to treat initially the ownership based on what the independent appraisal was. But what happens when there's an adjustment years later? I think to give reality to this, you need an economic adjustment provision. And what I would suggest doing is having an independent accounting firm give a calculation as to which trusts or entities or people owe money to which others, and even add an interest component to that, so that we really have a true up to reflect the adjustment made on audit. I think that could be quite important. And there's an example there. Another thing that I think you can integrate into some of these transactions, and this was based on the Ward opinion, which took a look at the King adjustment clause and commented. And the court kind of said, listen, you got this wonderful adjustment clause, but how do we know anyone's going to really ever make these adjustments? So one of the ways that I think you can do that without a great deal of difficulty or cost, again, and we're focused on larger transactions where this additional work may be well warranted, is to have an independent escrow agent. Consider having an independent law firm. Maybe the client has separate corporate counsel and you're estate planning counsel. Have that corporate counsel as an independent firm that's not doing perhaps the estate plan, hold all the documents of title in escrow pursuant to an escrow agreement, which is what you'd have in an independent transaction. And you can use that to assure that the shares will be properly adjusted, because you have an independent escrow agent that's mandated under the escrow agreement when certain events occur to issue stock powers and so on and so forth, or membership interest assignments to reflect the proper ownership in the proper people. And that will address, on the bottom of slide 33, an issue that the Ward Court noticed. Step or deferred interest. Does anybody want to comment on that? So here's an idea, an issue. Client wants to get some planning in place because they're concerned what might come down in the 2020 election. We don't know what will happen, but they'd rather be safe and have planning done. Problem is the client's in the middle of an international expansion for their business, and cash flow is really needed to fund these business expansions. And it makes it difficult to meet interest payments on a note that's going to be used in a sale to a grant or trust. In other words, the business entity doesn't have enough cash flow to make a large enough distribution for a number of years while this expansion is going on in order to fund note payments. So there's really two approaches, and I'll let Jonathan explain the second one after I explain this one. So one approach is to use a step or deferred note. In other words, bake into the process what the client thinks from a cash flow perspective is viable and supportable. So perhaps for the first couple of years, you pay 1% interest, another couple of years, 2% interest, and then after that, you pay a sufficient interest rate so that the note interest at least equals, if not exceeds, the AFR, so that on a present value basis, you've complied with the AFR interest rate. The OID rules will be triggered, but it's a grant or trust and it may not matter. But by baking this stuff into the interest rate in the note from the beginning, you may have solved the issue that's coming down the road. So that's just one thought on how to do it. Jonathan, you when we chatted about this, you had suggested using a note to pay the interest that may not be paid. Do you want to comment on that?
Yes, well, I think it's very important, unless you're doing a split dollar note where the regulations state you don't have to pay interest on a current basis and promise that they won't use the failure to pay that interest as evidence that it's not going to be treated as a loan for split dollar purposes. You want to pay something currently. Marty has suggested, the client says, well, I can always pay 1%. So why don't I pay 1% for the first 2, 3, 4, 5 years, and then I'll go to 2% and I'll go to 3%. But in all events, I will pay a sufficient interest so that there is no gift now. But as Marty said, you will have original issue discount interest. But again, that's an income tax issue. And if you're doing this with a grantor trust, it's really not going to matter. If that loan stays outstanding after the lender dies, then you will have OID interest that you're going to have to pay. What I've done, because I've never wanted to accrue the interest, because there is an indication in some cases that the IRS and the courts will use that as evidence that it really wasn't a note, is to actually pay the interest with new notes. So you say we're going to pay, the AFR interest each and every year. It's a balloon loan, and it's going to be payable in year 9 or 10 or whatever. You would give a new note for each year's interest. So every year you would have the borrower, in effect, the trust that bought the assets, give a note back equal to the AFR interest for that year. I can't, and yes, and you should, if to the extent you can pay, you pay it. So if you can afford to pay 1%, well, you pay 1%, and if the AFR was 2 when you did it, you'd give a note for 1%. That's just an alternative way of doing it, but as Marty knows, I'm in complete agreement. You should pay currently unless it's a split dollar loan.
So the bottom line is the following. If a client has a large estate and is fearful, which they surely should be, that if the Democrats are victorious in 2020, planning as we know it may be stymied or may not even be possible, they should plan to move assets now. I mean, I can't assure you that doing a note sale to a trust today is going to circumvent a wealth tax if one of the Democrats wins and somehow actually enacts a wealth tax, which I just don't see as practical to happen, but who knows? It's politics and anything can happen. But I would sure rather, if it were my wealth, that I moved it out of my estate before that, so at least I have a fighting chance. If the client has cash flow issues for whatever reason and can't make a note sale supportable, it doesn't mean you don't do the planning. We've given you 2 approaches to address it so you can keep moving the planning ball forward. 38, 39, one of the real issues with all of the planning we're doing, which I think is a struggle getting clients. Everybody's all excited when they're doing the transaction. They're all psyched. It's really exciting, and they're doing good planning. But once the plan is implemented, getting the clients back to the table, which I think has to happen at least annually with the entire planning team, to administer the plan gets sometimes more difficult than pulling teeth because they just don't see the importance of it. Does anyone want to comment on Wiley and how that sort of suggests that paying attention to the administrative aspects of these structures once they're in place is important?
Well, Wiley is actually a very, very scary case, and it's scary because after years of litigation about when the income of a trust would be taxed to the grantor, the Treasury issued regulations which now are contained in Subpart E of Part 1 of Subchapter J of the Code, the so-called grantor trust rules. And Section 671 states, no other way to tax the income to the grantor can occur other than pursuant to this subpart. And yet the Wiley case, the court basically said, we don't care. Now, this was a situation where the best way I think you can look at it, or I hope we can look at it as, this was a case of a sham. It really wasn't a trust. It really didn't have that kind of relationship that you want with a trust. This was just another pocketbook for the grantor. And I wish they had phrased it that way, but they basically overrode the grantor trust rules. It's a sorry case, but if you really abuse the system, whether it's for income tax or gift tax or estate tax or whatever, if you really abuse the system, you may not have your transaction respected, even though you've done everything that has the appearance of being exactly as the code says. But it's something that I think, if you haven't read the Wiley case, you need to read the Wiley case.
Now, I can't say that had they had meetings and documented the independence of the trust protector action, that it would have given a different result, but it's certainly worth a try. So I kind of put this case here just as a caution and warning that we need to be very mindful of proper administration of trusts. I think it was Joy that wanted to comment.
No, it was Sandy. So Sandy, I would say we need to be, that's okay, we need to be cognizant of the terms of trust from an administrative perspective for more reasons than just the income taxes and the potential that the IRS may take action to indicate that a trust is not what it purports to be. There's fiduciary liability if you're not following the terms of the trust. I'm right now in trial on an undue influence case where none of the fiduciaries followed or administered any of the trust according to their terms and moved assets from one trust to another. And we're quite frankly arguing that it's an indicia of undue influence because we were dealing with an incapacitated grantor when all the shenanigans were occurring. So there's many reasons why it's important that the trustee, whether it's a trustee or trust protector or other people involved in the administration of a trust, actually follow what the trust provides for.
We're at the top of the hour, but I'd like to just go on for another 5 minutes and let Sandy comment to the extent she can on when you're doing planning for really every client, but certainly in the context of this presentation on larger estates and some of the complex planning with the risks, the issues, and the uncertainties that we've talked about with a lot of the techniques and positions that we've discussed. Sandy, maybe you can comment, and I'm not going to advance the slides unless you ask me to. You can just comment in general for a few minutes on what practitioners can do to protect themselves more, given the uncertainty of all this type of planning that we've been discussing.
Well, I think it's important that whenever we're providing counsel to our clients, whether it's in these high net worth estate planning situations or any other situation, that we inform our clients that even processes that we've used for estate planning for decades doesn't mean it'll always work. Laws change, circumstances change, nothing's set in stone. Estate planning has inherent risks that are associated with it. And so making sure that we don't oversell a technique, that we don't convey to our clients that there are no risks involved and things will absolutely work just because one tax court case came out one way and seems to support it, or their PLRs, which, you know, you might say, well, it indicates, but they're not binding on your particular transaction, doesn't mean it'll work in your situation. And it also, I think it's important we make clear who our client is and who our duties run to. When you're having meetings with the family to explain how the plan will operate, you don't want to put them in a position where they believe you are their attorney and you are making representations about how the plan will work, when we never know whether the plans we put into place will actually work the way they're intended. And there are so many things that others involved in the process, including the grantor, may do to screw it up. So, you know, being careful in identifying those risks. And Marty, you and I and Howard wrote an article about how it might be helpful to identify some of those risks, but be careful in the way you identify the risks so that you don't provide a roadmap to the IRS or to others in terms of helping them to challenge the transaction. but documenting, business purposes, estate planning purposes, various reasons why you may be engaging in the transaction, the grantor intent, as opposed to saying it absolutely will work in a certain way. And I think using intent language in the document or in a separate document may be helpful in the event something does happen and it doesn't work the way it's planned. Sometimes you can go into court and use that intent to effectuate a reformation or a modification in order to help protect or save at least some aspect of the plan. I think we could probably advance the slide at this point. Client communications are really important, making sure they're kept advised. And also, I think also informing our clients that we don't have a duty to advise them of changes that occur in the law, because if we assume that duty and we don't provide notice, maybe we don't even know where the client went to, we don't have a way of contacting them, do we put ourselves at some risk? So I like to make sure that I have a clear delineation as to when the engagement ends. Any future communication is not they shouldn't rely on me advising them that there's a change in the law. If I do so, I'm doing so gratuitously. They're also responsible for looking at things that are occurring in the market as a whole, such as that may appear in the news or on whether that's in a written format or an electronic format or on the TV. Make sure you send documents to the client well in advance, especially in a complicated situation, so that they have time to review it and ask you questions. Don't have them sign it until you're comfortable that they really understand what is involved and what is going on, and making sure that they understand what their duties are, that they've provided you with accurate information. Because if you've got bum information, you may not be able to create an effective plan. And if things change in the client's life, that may impact the plan. And so staying in touch with you and letting you know when changes occur. And I even say to my clients, look, every 4 years, if you don't do it every year, at a minimum, every year we have a presidential election, pull those documents out and see if they still do what you want them to do. Now, if we did something that's irrevocable, we may not be able to change it, but there may be things that we can do, such as swapping out assets or borrowing against an irrevocable trust. But if we're not reviewing the transaction, we certainly can't react to changes that have occurred.
I think we should wrap up. There's a number of slides following with more of some of Sandy's comments on some of these issues and things to think about. But the key is trying to just give you some practical ideas on how to plan safer when you start undertaking some of the planning that we spoke about in this presentation. For general information, every one of the webinars that we present is recorded. The recordings are posted to schenkmanlaw.com/webinars. So if you want to see a replay or part one to this today's session, or the program that Sandy talked about, all those materials are there. If you want the article Sandy mentioned, you can email Sandy or me and we'll be happy to provide it. I'd like to thank Sandy, Joy, and Jonathan for participating, and Peak and Interactive Legal for their sponsorship and support for the program. Thank you everyone for joining us, and thank you everyone for participating.
Thank you.
Thank you.